now about inflation and recessions, etc. But what I want to go under the hood in this video. I'm going to look at investing trends, finding potential winners and losers for this 2022 and 2023, maybe a bit more recession, because it's important to look at, the data and understand it and have some thoughts about this to see how you can improve your investing. So let's have a look. Well, we all know about supply inflation. I predicted this years before the press. You can have a look at my videos, that I did, years before on my Facebook, warning people about this and whatever. Anyway, I'm not going to go into that. Everyone knows. And I'm going to be looking at restaurants because they're a good, kind of meter or they give a lot of signal for the whole economy, because there's such a big quick service restaurants, fast foods and restaurants are a really good sector to see how things are doing, and they're good for trends as well. Plus I invest in some of these as well. So if we look at it, 1 second, my bad. I think utilities could be really important. There was an article yesterday saying that like small businesses are going to have their costs are going to treble within the next 6 months. And some companies are saying that their input costs per restaurant have gone from £25,000, probably put this for any currency to a certain extent, and they've trebled to 60. And large restaurants have gone from like 200K to £600,000 just for their utilities. And I think my brother-in-law works in America, and he says that utilities are not as big. And I think it's really played out more in Europe at the moment because of there's a conflict at the time of recording this video between Russia and Europe. And Russia produces a lot of the oil and gas for the region, and that's really shooting up the input costs, and particularly for restaurants and small businesses. I wonder whether this will filter into the Middle East and Africa, just because they will be importers or net importers of oil and gas. But I'm particularly focused on Europe. The reason why this could actually impact America and North America is because a lot of big firms, fast food companies, restaurant companies, have operations in Europe, the Middle East, and Africa. For big firms, it could easily be 30% of their total revenue comes from Europe, from EMEA, from Europe, Middle East, and Africa. So, that's going to be interesting. And stay tuned for this whole video, guys, because at the end of this deck, I'm actually going to analyze some big companies and to actually forecast or have a think about the input costs for them. So I think one of the big things is about the size of the firm, the economies of scale for, whoops, spelled that wrong. But that is quite important, because in the article that I read yesterday, which was from the Evening Standard in London, they were talking about small to medium-sized companies that have maybe 1 or 2 locations. But I think the size of the firm could be a dramatic variable in terms of who survives and who dies in this recession, as in terms of the businesses. And I think correlated to the size of the firm to a certain extent is also the strength of the brands. Some brands in recessions don't do that badly. And in fact, some actually grow. I've got experience in this. I'm not just talking from, my opinion. I invested in companies that did incredibly well in the recession back in many, many years ago. I invested in Domino's Pizza, and that grew in the recession. I think it went up, 5 times, 500%. I also invested in some cyclical companies like house builders that went up 600%. This is why a lot of the market fell 30% or 40%. So I've got a lot of experience investing in companies and spotting trends in recessions where companies go up a lot. What else we got? Demand constriction, sticky demand. So what's vulnerable and what is sticky? Some things in society are more vulnerable during cyclical downturns or in recessions. Now, what is typically vulnerable? Well, people call them kind of discretionary costs, or costs that can be cut out of budgets because they're not seen as having sticky demands or being really important. Now, the reason I have to go deeper into this is too simplistic. So, share of wallet, this is a good way of thinking about things. What's essential or high priority for big spenders in society? And you can break down big spenders into different sections. So let's just do that now, and I'll talk through all of them. Families. Families are a big section of society because they have to spend a lot of money. You know, if you think about it, if there's a four-person family, they're going to have a 4-bedroom house probably, and they're going to be spending for 4 people, and they're making purchase decisions for 4 people. They probably have to bring in a lot of money to support their families, and each purchasing decision is not for one person, it's for more. Second, big spenders are singletons, people that are single, couples, you know, double income, no kids, or double income, that's dinks or dinkies, double income, no kids yet. I fall in under that category. Then there's the pink pounds, or sometimes people make the assumption or stereotype that gay people have more money, and sometimes they do. They tend to fall under the singletons category, or the dinks category, or the dinkies category. So they often, people talk about them having high purchasing power. Also the grey pounds, you know, retired singletons, and then you've got the retired couples and grandparents. You know, in a lot of parts of the world, these, you know, this section of society has the most amount of money at the moment. They're homeowners. They've benefited from, you know, inflation and from the price appreciation of their assets, including property. Then you got a section which maybe has less income, but they certainly do spend a lot of money. You know, that they still have to spend money, and that's the unemployed. This might be people, it's not necessarily people that have low assets. They may, you know, in a recession, more people become unemployed. They may still have lots of savings. They may still have lots of assets. You know, you could argue that some people in the crypto world, they might be unemployed, but they might have a lot of money. So it's not just the poor unemployed. You can break it down in different sections. The reason I talk about this is each like spending section, if you like, you can think about their share of wallet or their discretionary income is slightly different. And the way I would, for me, analyze the winners and losers for the recession is what products and services do each of these big segments of society have to spend money on, right? So you've got, if you think about it, you can think about it in terms of like what a person has to always spend money on, and what these segments have to always spend money on. Families, right? Well, families, they all, and let's just think about all of them, to be honest. Everyone has to pay for bills. Am I going to invest in a utility company? Probably not. But I do think oil and gas, you know, everyone has to pay bills. And particularly at the moment, there is price inflation with the oil and gas rate, talking about in 2022. So I do have some investments in oil and gas and eco energy companies. So that's energy, you know, people have to use that. People have to pay their mortgages. So banks could do quite well. And I do think there are some interesting stock ideas for banks as well. If I have time, I want to do some videos on the UK banks because I think they're massively undervalued. And a lot of these, you know, a lot of these segments will have mortgages. A lot of these segments will be paying bills. You know, almost everyone on this list will have that. That is sticky, and that is a big share of wallet as well. And if you think about it, as a percentage of income, people are going to have to spend much more on their mortgages and their bills in 2022, in 2023, and maybe beyond. Now we get into discretionary spends. What else do people need to spend money on? Well, they need to spend money on a clothes potentially. You know, if they're changing jobs, they might need to buy, you know, smarter clothing. Then you're going into kind of things which are a bit more granular, such as the car market. You know, singletons might want to have a car, but I think it really depends on where they're living. For example, you know, in London and big cities in around the world, New York, London, people might not drive cars as much as use big transport systems. So I think you know, you can get very granular. You can start thinking about clothing, about tech, about transport like cars and big purchases, etc. But I think it's more important to be thinking about your own investing portfolio. And for mine, you know, I'm quite heavy into restaurants, leisure, and robotics around restaurants. So in this next section of the video, make sure to stay tuned. So I think this is going to be the most impactful for you. Even if you're not investing in restaurants, this analysis, I think, you know, the way I think it is quite helpful for investing. And just a caveat and give you some reasoning behind my investing kind of knowledge and thought process. You know, I do this similar analysis for Meta, for WhatsApp, for my job. And I did a kind of global analysis recently for them. And my analysis was like, where should we be spending money? Where should Meta be investing for WhatsApp? And, you know, this is millions of pounds we're talking here. And my analysis that I did maybe 2 months ago was recently validated by Google, who looked at like loads of different variables globally. And I chose 12 countries, and guess what? Out of hundreds of countries in the world, or you know, the top 100 countries, the 12 that I chose was completely 100% validated by Google's data-driven research, and mine was done from my mind, from my head. And you know, everyone was quite impressed that basically my analysis was spot on Google's data-driven analysis, and that was just from my head. So I think that my approach to, you know, analysis and strategy and thinking about trends is pretty spot on. So going back to the winners and losers of the recession, who's this going to be? Well, I personally have a thesis that franchises in the restaurant space are going to do quite well from the recession. I want to validate that now. So I'm going to walk you through my process. I'm going to look at Catebox because that's one of my investments. So let's have a look at this now. It's not going to take me too long, and definitely stick around. So the first thing to do is when you look at one of these companies, is just type in investor is the company and then investor relations. Then you can actually dig in and you can get the real data from the company. In terms of Catebox, I'm going to be going to regulatory news. Might have to tick that I'm a UK investor here. No, I don't. So I'm going to go to the most recent annual report and account. Sorry, that's just that's some news. I actually want the annual report. Stick with me, guys. It's really important. That's just the news. My bad. That's probably the release they're saying when the new one will come. So let's just go on the most recent report. Here we go. Stick with me, guys. It's going to be really insightful. Okay, cool. So we can see, and I already did a review of this. If you want to look at the actual annual report information for Catebox, I did a really good video about this recently. So you can see here the profit is 45% gross profit. Pre-tax profit is up 83%. Cash, everything's going up, right? But what we're looking at here is the input costs. So I need to go down. We're obviously going to talk about all the growth figures. You know, franchise information, total turnover is up 55%. So they're doing quite well. But let's look at the input costs because everyone's talking about inflation, etc. So, right, revenue's gone from 21 million to 33. Gross profit has gone up 50%. Operational expenditure has gone from 6 to 8. So that's nearly, I don't know what that is, like 30% increase or something. But I really want to dig into this. So let's like dig in to the actual costs here. So property, they're talking about buying and selling property here. We may need to go into the actual cost of sales here. So the actual cost of sales has gone up quite a lot. It's gone up like about 60% or something. So we need to actually dig out here. So out of that 6 or 7 million increase, about 2.6 million was just from admin. So we can remove 2.6, that leaves about 5. So we need to look at that on, let's see if they break that down. They should. Okay, so what have we got here? These are the assets, so we need to look at liabilities. Okay, so about 4 million is not related to costs. So let's just go back quickly. So I'm doing this top of my head. So cost of sales was 17, 7 million was an increase. What did we say? 2 million of the 7 is admin. 4 million of the 7 is current liabilities, potentially. So that leaves 1 million left, right? Cost of sales. So there's 1 million left that's unaccounted for. Let's have a look down and just see if there's anything else. Stick with me, guys. Some of this analysis is going to be really important for identifying trends. Okay, so we have to dig down a little bit deeper just to see if there's anything. Franchise package. So that includes like a store fit out and training. Now, I think the big thing about restaurants and franchises here, guys, and well done for sticking around if you're still watching this video, because this is the really insightful bits. Franchises sell kind of franchise package, and the franchisee has to pay for this. And for big companies, it can be substantial. I think for McDonald's, it's over $1 million or £1 million. I know for Domino's Pizza, it's over £250,000, which I think is like $400,000. Obviously, it depends where you are in the world, but I'm just talking about it for the UK for now. You can think about this in dollars or euros, or you can compare it to your local country just by Googling it. But essentially, big franchise restaurants and fast food, QSR companies, quick service restaurant companies, charge for their franchisees. So that's one of the reasons why I think there isn't a lot of costs for them, because they make so much money up front. Depreciation, leases. So leases are going to be a high percentage lease liability, but that's not to do with like bills. And actually, I think leases, that input cost is actually going to go down. So if we just say we're on page 15, let's just quickly have a look at the breakdown of leases. Actually, it's quite small, 260 out of the 4 million. What's the biggest? Trade and other paid receivables. So that's just going to be like the cost of doing services, like for Cake Box in particular, it's going to be like, cream and things like that. The ingredients to bake the cakes and whatnot. Let's see if there's anything else here. Probably be zooming in here. Sorry, guys. Staff costs. So staff costs have gone up by over $1 million. That's with the growth of the company. So I think we've basically accounted for like a lot of the costs here. I actually don't see utilities. There's a quick thing here where you can just type in utilities, see if anything comes up. Utilities. Here we go. So the costs of their utilities has gone up like 10K in the year 2021 to 2022. So I think this is really important. I told you about that article that I read yesterday. I'll quickly just see if I can find it. Evening Standard, bills, utilities, small businesses. If it takes me longer than 10 seconds, then I won't. Energy crisis must help small businesses. So in the UK, like the price cap on energy and utilities is uncapped. So yeah, this is the article basically, or this is one of the articles. And they're not even allowing me to look at it. But essentially what they're saying, oh my God. What they're basically saying is that small businesses are going to suffer massively. Now, Cake Box was a small business when I started investing, but it is growing. And I think what I wanted to show you here is they have about nearly 200 stores right now. They only had about 30 or 40, I think, when they, a couple of years ago. So they're growing at between 30 and 60 stores a year. But let's look at the utilities. It's only 300K. Now, if you look at the wages, that's a bit more important. So that goes back to the deck here. If we go back, we look at the winners and losers, and we think about supply inflation, that is going to go up. If you look at the cost of goods sold, that will go up, but big companies, they have a bit more flexibility. They've got economies of scale. They've got the strength of the brand. So sales aren't going to decrease if they have a strong brand, right? And input costs are not going to be as dramatic when you have a bigger firm with economies of scale. Who's vulnerable in the restaurant sector? I think it's going to be restaurant directly owned restaurants are going to have more suffering than franchise restaurants, because they can charge this franchise fee. They get a lot of money up front. And if we think about the share of wallet, we'll talk about that in a minute. But the thing that I've just recognized here, bills are not significant. Bills are not significant. And look, let's look at advertising. These guys at Catebox have reduced their advertising even when their revenue's gone up like just an insane amount. The revenue's like gone up 50% and the profit's gone up nearly 50% and the EBITDA's gone up 80%, and they've reduced their advertising costs. So some companies have a strong brand, and as they grow, their store count, which Catebox is doing, then their income just rockets. And I think it's really important to think about, the company as opposed, in relation to the economy. And if we go back to like what people spend money on, what I found in my investing career is people will still buy fast food, especially if it's a good brand like Domino's Pizza. People were still ordering in the big recession of 2008, 2009, 2010. It didn't suffer. And actually, Catebox mentions that they started the company in the recession and they grew in that recession as well. So, people are still going to have birthdays, for example. All of these sections of society are still going to order pizza. They're still going to have birthdays. If they have a kid, they're going to buy them a cake for their birthday, right? If they're in a relationship, they are going to have cakes. You can imagine the Pink Pound probably might be interested in buying cakes. And if they're older, they're probably going to treat their grandkids as well. If they're retired or whatnot, they're going to be treating each other to cakes. Depending on the segment of the unemployed, the crypto millionaires and the business owners might have a bit more money. But even if you've been made redundant and you're unemployed, there's a good chance you're still going to have a cupcake or a cake on your birthday, or you're going to be buying one for friends and family. So that's an interesting way of thinking about it. You can think about the share of wallet, and then I suggest strongly that you read through, if you're an investor and you want to be a serious investor, not just a hoper or whatever. It's important to look at the analysis and to think about the numbers. When you see like changes like this in a recession, companies growing 50%, profit going up 50%, pre-tax profit going up 80%, earnings per share 88%. This is a good company, and it's important to think about, will the share of wallet decrease? I don't think it will for Catebox. I'm not going to look at some of my other companies because I think it's the same. Tortilla, I've done an investment analysis off in some other videos. Check that out. It's going to be, I think, the next Chipotle. I think that's going to grow incredibly. They've got less than 100 stores at the moment. I wouldn't be surprised if they had 500 stores in 5 years' time, and maybe in 10 years, a couple of thousand stores. Let's see. Catebox, I wouldn't be surprised if that has 1,000 stores in a few years potentially. Anyway, this is investing trends, and this is about the winners and losers. So if we think about the winners and losers, I'll just do it right now for you. So I think the winners are probably going to be high strength brands with sticky products and services. Franchises will do well. Software as a service, I think, will do well if it's sticky. There are some like software things that people like have to use. So I'd say like, things like I would probably say Amazon Web Services and Google Drive. Like people like have to store files. So there's some software as a service which is like really sticky. Others might have some recessionary impact. Like people will probably spend less money on Uber and ride hailing, and maybe even like Deliveroo, which I'm an investor in, sadly. But you know, they might spend less money on some of those things. But if you think within people like Deliveroo, I think that people will still buy, you know, McDonald's, Domino's Pizza, Cake Box, because they're high strength bands. They have great food, sticky products. It's funny, isn't it? Cake Box, sticky products. Ha ha ha. Anyway, you know, people do like the cakes. They're incredible. We had some Cake Box cupcakes at my wedding, and like they were just, people loved them. You know, they really did. So anyway, I'm going to stop sharing my screen here. Let me know what you guys think. Sorry that it's a little bit dark here. It is, you know, it is morning. It's just raining, like it does in the UK. Let me know what you guys think of my analysis. Like I say, it's not the first time I've invested in a recession. I did very well from investing in the recession of 2008 to 2010, and I expect that I'll do well in this recession as well. And I was just looking at the restaurant industry, and with a particular deep dive into Cake Box. Like I mentioned, I've done even further deep dives into analysis of Cake Box, Tortilla, and other companies, both listed and startup and angel investments on this channel. Make sure to check those out. If you like this video, make sure to smash the like button. If you like the idea of investing in startups, or you do already invest in startups, I should have a link in the description where you can sign up to some startups that are raising capital in Europe, in the UK and Europe, with the website Seeders. If you invest using that link, you get £25. If you invest, I think 150 within a 1 month period. So definitely check that out. Helps support the channel as well, because I'll get £25 as well. So you help me and I help you, and that will help me to make even more videos about equities and startups as well. Knowledge is power, especially the right kind of knowledge. Progress is everything, guys. I'll see you in the next upcoming video. Make sure to check out my other videos, which should pop up. They should be related to what you might be interested in. Take care. Cheers.